A Roth IRA is a wonderful account to build tax-free income, but only if you know all the little rules and nuances about them so that you can use them most effectively. In today's video, I'm going to share with you 7 little-known facts about Roth IRAs so you can become a better planner. Hey everybody, I'm James Conole, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. The wonderful thing about Roth IRAs is the more that you have in Roth IRAs, the more your account grows in Roth IRAs, the more tax-free income you'll have in retirement. So we all love that aspect of Roth IRAs, but there's little rules and nuances about these accounts that enable us to get even more out of them and plan even more effectively with them. So I'm going to walk through 7 little known facts so you can become a better investor, a better planner, and more effectively utilize your Roth IRA. The first little known fact about Roth IRAs is that any contributions you make to them can be withdrawn penalty-free and tax-free at any time. So this is different than most retirement accounts. With an IRA or 401k contributions, you can't touch that until 59.5 without paying a 10% penalty and taxes. Well, with a Roth IRA, any contributions you make, those come out completely tax-free anytime. So if you're 20 years old or 30 years old or 40 years old, really any age, and you make a contribution to a Roth, you don't have to wait until 59.5 to access that. You can pull that out at any time. What you can't touch until 59.5 without penalty is the growth on those contributions. But let's say from age 20 to 30, you contributed $5,000 per year to a Roth IRA. That's $50,000 of contributions, and let's say you got $40,000 of growth. So you have $90,000 in your Roth IRA at that point. You can pull out that $50,000 at any time and not pay any taxes or penalties. Now, ideally, you're leaving it in so that you can keep getting growth, keep getting tax-free growth on those assets. But if you need those dollars, they're accessible without tax, without penalty at any time. The second thing to know about Roth IRAs is there's something called the 5-year rule. So the 5-year rule says that in order to be able to fully access a Roth IRA, not only do you have to be age 59.5 if you want to be able to access the growth tax-free, but you also have to have waited 5 years from the time the account was funded initially. So if you're 60 years old and you hear about these benefits of these wonderful Roth IRAs and you say, wonderful, I'm going to go start this. Well, you fund the account, you can always take your contributions out tax-free, as we mentioned in the last point, but you can't touch the growth for 5 years. You need to wait for that 5-year window to pass, then the growth becomes eligible, even if you're already over age 59.5. Now, not just that, but there's a different 5-year rule for Roth conversions. If you're doing Roth conversions and every single time you make a conversion, you have a separate 5-year tax window in order to be able to access those particular funds. So as you're coordinating this, Roth contributions, you have to have had the account funded. Now this could be any account. If you started a Roth account years ago, but now you have a new one, that already started the clock for you. But you need that funded for 5 years, and then all future contributions are good to go. But with conversions, every new conversion you do, there's a new 5-year window. Now, when you go to pull funds from a Roth, the IRS is going to treat this by default as contributions come out first. Once you've pulled out all your contributions, conversions come out next in order in which they were converted. Once you've pulled all that out, then growth comes out third. So that's the order of operations that the IRS is going to treat withdrawn funds as. And the other thing to note is people say, well, this seems like a bad idea. Why would I fund this thing when I may be 60 or 65 or 70 even? Well, keep in mind the benefit of Roth IRAs doesn't come today. It comes as those funds grow tax-free, and the longer they stay in the account, the more the benefits you have. So for most people, this isn't actually an issue. It's not an issue because when you're doing Roth conversions, it's not to convert the account and then turn around next year and spend those dollars. You're doing conversions so you can take advantage of years of compound growth and then ideally use these funds later in retirement. But you do have to keep in mind there's a 5-year rule for your first contribution. There's separate 5-year rules for each conversion that you make, and even there's a 5-year rule for your beneficiaries. So if you make your first Roth contribution today, in a couple years from now you pass away and let's say a child inherits it, the child must wait 3 more years for your initial 5-year clock to run out before they can access the growth on that Roth IRA tax-free. The third little known fact about Roth IRAs is even if you make too much money to contribute directly to a Roth IRA, you may be eligible for a backdoor Roth conversion. So on the screen here, you'll see the income limits for Roth IRAs. And if you're single and you make over $144,000 of adjusted gross income, you're no longer eligible to contribute directly to a Roth IRA. If you're married filing jointly and you make over $214,000 combined, you're no longer eligible to contribute directly to a Roth IRA. This is where a backdoor Roth conversion may come into play. If you make over these income limits, you cannot put money directly in a Roth IRA. What you may be eligible to do is to do that backdoor Roth conversion, which means you fund a non-deductible traditional IRA, still has the same limits, the same contribution limits. What you then do is you convert that after-tax balance into your Roth IRA, and because you're converting after-tax money into an after-tax account, there's no taxes on that conversion. Now, there's a whole lot of details here. You have to file Form 8606 with the IRS to let them know that you're doing this. I'm going to link to a video at the end of this to show you exactly what mechanism or exactly what process you go through to make this happen. But do know that if you make too much to contribute directly to a Roth IRA, you still may be eligible for a backdoor Roth conversion. The next little known facts about Roth IRAs is they're not subject to required minimum distributions. Now, this is a huge benefit because, again, the main benefit of Roth IRAs is the growth that happens on them because all that growth is tax-free. So when you have required minimum distributions on IRA balances or 401k balances, you're being forced to distribute larger and larger portions of that account, which is diminishing the account balance or at least not allowing the account balance to keep growing like it otherwise would have. Well, with a Roth IRA, you don't have to worry about this. You can keep that account balance growing as long as you want to. Now, your inheritance or your heirs, when they inherit it, they will have to distribute the Roth IRA over 10 years, but you can allow that to continue growing, and as of now, there are no required minimum distributions on those accounts. The fifth little known detail about Roth IRAs is they're not included in provisional income. So when you're trying to determine how much of your Social Security is included in your taxable income, it's based on something called provisional income. So provisional income is a formula that says, look at all these different income sources, and if they add up to certain thresholds, it means more and more of your Social Security is included in your adjusted gross income. Well, if most of your income's coming from Roth IRAs, let's say all of your income's coming from either Roth IRAs or Social Security, that's going to keep your provisional income very low, which on the one hand, your Roth IRA withdrawals are already tax-free, but on the other hand, that might also make your Social Security tax-free because your provisional income is under certain thresholds. So as you're implementing your tax planning, understand how Roth withdrawals not only impact your taxable income, but also could impact your provisional income, which shows you how much of your Social Security is taxed. The sixth little known detail about Roth IRAs is it helps to keep your Medicare surcharges lower. So your adjusted gross income is going to determine your IRMA surcharges, which is essentially the surcharge on your Medicare Premium Part B and Part D, and the higher your adjusted gross income, the more of those surcharges that you're going to be paying. Now, if more income is coming from your Roth, it's keeping your adjusted gross income lower, which is helping you to avoid premium surcharges. So with your withdrawal strategy in retirement, as you're pulling funds maybe from your IRA or your Roth IRA or Social Security or pension, doing so strategically to stay under certain ordinary income tax brackets, but also under the IRMA brackets, that's going to help you to keep your Medicare surcharges as low as possible. And then finally, the last little known detail about Roth IRAs is even if you're not earning any income, you are still eligible for a Roth IRA contribution as long as your spouse has earned income. So maybe one spouse is a stay-at-home spouse, or maybe one spouse is already retired. Whatever it is, as long as one spouse has income and you're not above those income limits, the both of you can make Roth IRA contributions. This is important because, again, the more you can get into Roth IRAs, obviously understanding the context of your priorities and your other goals, but the more you get into Roth IRAs, the more tax-free income you'll have in retirement. The more tax-free income you have in retirement, the higher your retirement lifestyle can be, and everything just works out better. So you're eligible to make a spousal IRA if you have no earned income, as long as your spouse does. So spousal IRAs and spousal Roth IRA contributions, those are available to you as long as there's earned income from one of the spouses. So those are 7 little known facts about Roth IRAs. And when you understand that, you can understand how to most effectively use Roth IRAs in your planning. Now, I mentioned that with the backdoor Roth conversions, there are a lot of details. You really want to get it right. You really want to understand the mechanism by which that works, because if you don't, or if you miss something, it could end up costing you a lot. So in this video above, I walk you through step by step what a backdoor Roth conversion looks like and how you can use it most effectively for your situation. Once again, I'm James Conole, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.